Why are mortgage interest rates going up even though the Fed has cut the rates? Let's break it down as to why this is happening. When the Fed cuts interest rates, it's not a direct correlation to straight mortgage interest rates, where if they cut it, the interest rates are coming down. It's not what that means. When they cut interest rates, they're specifically cutting the federal funds rate. This rate that they're cutting typically affects short term costs. These are directly translated to things like credit cards and auto loans, for example. Mortgage rates, however, are tied to long term interest rates, like the yield on the 10-year treasury bond, for example. Mortgage interest rates are influenced not just by the Fed's decision, but strong economic factors also play a really big role into mortgage interest rates, whether they go up or down. So with that being said, here's what's going on right now as to why interest rates are going up and not coming down, even though the Fed has cut the rate. For one, to start, on paper, the US economy has been growing faster than expected. The best example of this is that job growth is up and consumer spending is holding up as well, which, we all know it's very expensive, so we of course have to spend money. But with those two factors there, it's an economic driver for interest rates. With a strong economy, investors get concerned about inflation again, which in turn leads them to demand higher returns on long-term yields like the 10-year treasury. Since mortgage rates, like I mentioned in the beginning, are tied to the 10-year treasury bond for the most part, this is why you're not seeing any mortgage interest rate relief right now. So to recap this, even if the Fed cuts interest rate, and you see it all over the news, if the overall economy is strong, or at least it's presented to us as it being strong, and the concern for inflation is up, mortgage rates can still rise even with a rate cut. While a major majority of interest rate cuts comes from the Fed, mortgage rates really truly react to the bigger picture of how the economy is doing more than what the Fed says, and they lean heavily on long-term 10-year treasury bonds.